We can do another round, I guess. To the gentleman from New Mexico, Mr. Pearce.
Thank you, Mr. Chairman. Mr. Andrews, Mr. Eagley points out that the loans coming off the books was one of the problems. In other words, the issuing institutions really didn't have much stake in seeing that the loan performed. Is that something that you see as a problem, or is that something you don't object to, keeping the loan somewhat on your books?
You know, community banks do carry mortgage loans on their books, and if they get concerned about interest rate risk, they can always do an interest rate risk swap.
So it's not a concern.
Or they can use Federal Home Loan Bank to.
So it's not a concern. It's
in other words, not a concern other than having the additional capital.
Right. Okay.
And so it's easier for banks to sell it and
right.
get a fee than provide more capital.
I just want to clarify that. Now, Mr. Stengel, you mentioned that that we really didn't have anything to worry about. That the market would come from on the covered bonds would come from be issued by regulated institutions, highly regulated institutions. Didn't all the collateralized debt obligations and the MBS didn't those originate in highly regulated institutions? I mean, just yes or no. And
no, sir. I would say most of them.
They did not.
I would say most of them originated with institutions that are not necessarily as highly regulated as insured depository institutions.
Okay. All right. I find it curious, Mr. D'Alessio. That's kind of hard to say from a West Texas accent. Garcia and Smith works a lot better with me. So you said that the process was that we transferred risk, the underwriting went bad, and then the economy went bad. Now, somewhere in there, the underwriting, I mean, the market just assumed the underwriters were not even going to look. That the truth was we had entire bonds issued with no performing loans anywhere in them. That's the reason that 4 or 5 institutions made a bunch of money selling short. And so it appears that it was far more complex than just the transfer of risk. The underwriting went bad, and the economy went bad. It looked like a disorganized structure that simply never checked itself, that bad loans were made with never the potential of paying back. 2 years and you're going to sell that house, and you don't really have to make any initial payment, no principal, no interest. And so to say that simply the transfer of risk was the originating thing, I think there was a hunger in the market for these instruments that allowed tremendous profits to be made as long as the game was going up. And then when the game went the other way, we tagged the taxpayer with the downside. And so you stand by the statement that it was simple process, transfer of risk, underwriting went bad, the economy went bad?
I do believe it's that simple, because I do think the incentives to relax the underwriting standards were enabled by the ability to more readily transfer the risk into a capital market system, which started to operate more so on the basis of what seemed to be an ever-increasing rise in home prices and a ever-lengthening favorable past historical experience.
Okay, I'll accept that. Mr. Stengel, you had mentioned that there's no liquidity, that there's a lack of liquidity, lack of funding, and I find just the opposite. I find the local community bankers telling me that they've got quite a bit of money to lend. Is number one, if they make one bad loan, they stand to lose their entire institution. And number two, now, the compliance reviews are more rigorous than the safety and soundness reviews, and that things that used to be simple exceptions are now written up as $50,000 fines. And they're saying, why in the world would we give a home loan when one small thing on a debt or on a flood insurance program, which we haven't collected flood insurance in New Mexico. We start at 3,000 feet above sea level, and we go higher than that. And so we're paying for the guys down on the coast, and yet one bad statement in there is a $50,000 fine. They're saying, why should we bear the risk? What do you base your statement on that small banks have no liquidity?
Well, on your comments about the regulatory exams, that may well be the case. And so I think your concerns may well be founded and certainly worth investigating. On the question about liquidity, the liquidity that exists today are all deposits that people have put into banks because they're afraid of investing their money elsewhere because the economic recovery has been fragile. And I think what you're going to see is when the economy turns, the deposits are going to get yanked out as people look for better yield. So today, I think there's probably plenty of liquidity. I suspect the banks have deposits they don't want because they can't make any money with them. And that when the economy turns, we're going to need these tools. We're going to need securitization again. We're going to need all of those tools to keep our economy growing.
Do you think the policy of paying interest on reserves is maybe contributing? In other words, just the banks can borrow at zero more or less and get 2% just out here. Is that maybe contributing also? You got no risk guarantees?
I'd be reticent to comment about monetary
I
policy, sir.
didn't want to get you into trick.
At least on
Thank
behalf,
you, Mr. Chairman.
at least
I
on
better
behalf
quit
of the
now.
council.
Can we just thank Mr. Pearce for those in the coastal regions with the flood problems? We do appreciate that help.
Yeah, I'd like to
we
second.
don't
I'd like to
deal with
second
good
that.
heart, Mr. Chairman. I'll
thank
tell
you very
you,
much.
there's angst about that whole deal.
Thank you. Mr. Stiver.